$74.6 billion. That's how much the Federal Reserve injected into the banking system on December 31st, 2025, not through normal channels, not through scheduled operations, through an emergency facility that wasn't supposed to be used at this scale, the largest single-day repo operation since the COVID-19 pandemic. And it happened while most Americans were preparing to watch the ball drop in Times Square. The official explanation: year-end liquidity management. Routine adjustments. Nothing to see here. But here's what they didn't mention in the press release. This wasn't just any cash injection. Of that $74.6 billion, $31.5 billion was backed by Treasury bonds. The remaining $43.1 billion was backed by mortgage-backed security. Someone needed emergency funding, and they needed it secured against the very instruments that collapsed the financial system in 2008. The timing wasn't coincidental. On the exact same day, silver punched through $85 per ounce, a price that would have seemed impossible just 12 months earlier when the metal was trading below $30. Gold surged past $4,600. And in Shanghai, physical silver was trading at a 12% premium over the paper price quoted in New York and London. Connect these three events. Record Fed injection. Record silver price. Record premium between East and West. This isn't year-end housekeeping. This is something else entirely. But this was only the beginning. To understand what happened on December 31st, you need to go back 3 weeks. On December 10th, the Federal Reserve quietly issued an implementation note directing the New York Fed to begin purchasing Treasury bills. The stated reason was maintaining an ample level of reserves. The unstated reason was far more concerning. Throughout December, the Fed purchased $40 billion in short-term Treasury bills. $15 billion replaced mortgage-backed securities that rolled off the balance sheet, but $23 billion were something called reserve management purchases. The Fed claimed this wasn't quantitative easing. They said it was simply maintaining the plumbing of the financial system. Here's why that explanation doesn't hold up. Quantitative tightening, the program designed to shrink the Fed's balance sheet, officially ended on December. After years of promising to normalize monetary policy, the Fed simply stopped. They had reduced holdings by just $1.4 trillion of the planned target before abandoning the effort entirely. The question nobody in mainstream financial media was asking: why did the Fed need to pivot from shrinking its balance sheet to expanding it in less than 30 days? The answer came in the repo market data. On December 29th, the standing repo facility usage jumped to $16 billion after printing close to zero for most of the month. Then it fell to $2 billion the next day. On December 31st, it exploded to $74.6 billion. The pattern suggests severe stress in overnight funding markets. The secured overnight financing rate, known as SOFR, rose to 3.87% on the last day of the year. Some repo transactions were recorded close to 4%. This was above the Fed's standing repo facility rate of 3.75%, creating what traders call an arbitrage opportunity, but it also meant something more troubling. Banks preferred to borrow from the Federal Reserve at emergency rates rather than from each other in the private market. When banks don't trust each other enough to lend overnight, that's not year-end housekeeping. That's a warning signal. The last time repo markets showed this kind of stress was September 20. Back then, overnight rates spiked unexpectedly, forcing the Fed to intervene with hundreds of billions in emergency lending. What followed was a series of quiet bailouts that the public didn't fully understand until years later. What came next changed everything. The data that explains the December 31st injection doesn't start in December. It starts in the silver vault. Throughout 2025, something unprecedented happened in the COMEX silver market. Physical delivery requests surged to levels not seen in decades. In December alone, approximately 65 million ounces were requested for physical delivery. That's 12,946 contracts, each representing 5,000 ounces of silver. But here's where the story gets interesting. COMEX didn't have 65 million ounces of registered silver available for delivery. According to warehouse reports, registered inventory had plummeted by over 60% from earlier in the year. By late December, only about 127 million ounces remained in the registered category, the metal specifically earmarked for delivery against futures contracts. The math doesn't work. When delivery requests exceed available supply, exchanges have two options. They can source physical metal from somewhere else, or they can settle in cash instead of metal. According to market analysts, an estimated 95% of December's delivery requests were forced into cash settlement rather than physical silver. Think about what that means. Traders holding futures contracts, believing they were entitled to real silver, were told they would receive dollars instead. The paper market, and the physical market had officially decoupled. On November 30th, a single block request came in for 36.65 million ounces of silver. One order, nearly 37 million ounces. That's over 1,000 metric tons of physical metal requested in a single transaction. Who places an order that size? And more importantly, why would they want physical delivery instead of simply rolling their futures position forward? The answer was sitting in China. And that's when things got interesting. On January 1st, 2026, China's new silver export restrictions went into effect. The Ministry of Commerce had announced the measures back in October, but the implications weren't fully understood until the deadline arrived. Under the new rules, Chinese companies must obtain special government licenses to export silver. Only 44 firms qualified for the 20. The qualification requirements are severe. Companies must produce at least 80 tons of silver annually, maintain ISO quality and environmental certifications, and demonstrate a $30 million credit line. This isn't a minor adjustment to trade policy. This is resource nationalism on a strategic scale. China exported over 4,600 tons of silver in the first 11 months of 2025. That flow has now been restricted to a handful of state-approved entities. Market analysts estimate the new controls will affect 60 to 70% of the global silver supply available for export. The state-run Securities Times quoted an unnamed industry insider saying, "The new policy formally elevates silver from an ordinary commodity to a strategic material. It's now on the same regulatory footing as rare earths, the minerals that China has previously weaponized in trade disputes." Tesla CEO Elon Musk responded on social media, "This is not good. Silver is needed in many industrial processes." He's right. Silver is essential for solar panels, electric vehicles, semiconductors, and advanced electronics. China's domestic solar industry alone consumes massive quantities of silver paste. By restricting exports, Beijing is ensuring its own manufacturers have priority access to supply while foreign competitors face shortages. But the restriction alone doesn't explain the December 31st Fed injection. The connection came through arbitrage. Throughout 2025, silver flowed from COMEX vaults in New York to London to cover acute shortages there. In just the first 2 weeks of October, roughly 29 million ounces were physically removed from COMEX warehouses and shipped across the Atlantic. This was the arbitrage trade in action. Buy futures in New York, take delivery, ship the metal to London where premiums were higher. But with China restricting exports starting January 1st, that arbitrage was about to become even more profitable. The Shanghai premium over London and New York had already reached 12%. Physical silver in China was trading at levels that made Western paper prices look like a discount. Someone was going to make enormous profits bridging that gap, or someone was going to suffer enormous losses if they were short silver and couldn't deliver. The Fed's $74.6 billion injection happened the day before China's export restrictions went into effect. Banks needed emergency cash secured against treasuries and mortgage-backed securities. The silver market was experiencing backwardation, where spot prices exceed futures prices, a classic warning sign of physical shortage. The dots were connecting, but this wasn't the final move. The silver market in January 2026 isn't operating like a normal commodity market. It's operating like a market under siege. Consider the numbers. Silver rose to $85.64 per ounce on January. That's up 187% compared to the same time last year. Over the past month alone, the price has risen 33%. This isn't normal price appreciation. This is a market being repriced in real time. Bank of America has issued a price target suggesting silver could reach between $135 and $309 per ounce. Goldman Sachs analysts are recommending clients increase precious metals exposure. Even traditionally conservative institutional investors are scrambling to secure physical metal. The reason becomes clear when you examine the supply deficit. 2025 marked the 5th consecutive year of global silver supply deficit. The Silver Institute estimated the shortfall at 230 million ounces. Industrial demand from solar panels, electric vehicles, and artificial intelligence applications consumed a record portion of supply. There simply wasn't enough silver to go around. Meanwhile, above-ground inventories continued to drain. COMEX registered silver fell by 35% since the start of London vault inventories hit near all-time lows.
with the LBMA reporting just 827 million ounces in December, down 23 million ounces from the previous month. Of that 827 million ounces in London, approximately 551 million are reportedly backing exchange-traded funds like SLV. That leaves a float of roughly 276 million ounces, with no way of knowing how much is actually available for delivery under market stress. The physical market is tightening while paper contracts continue trading as if unlimited supply exists. This divergence explains the backwardation. When the spot price exceeds the futures price, it signals that buyers want metal now and are willing to pay a premium to get it. They don't trust that future delivery will actually happen. They want physical silver. The CME Group responded to the volatility by raising margin requirements on silver futures twice. In 1 week, the Shanghai Gold Exchange raised its margin requirement to 20%. These are emergency measures designed to cool speculative. But margin hikes don't solve a fundamental supply problem. They just make it more expensive to bet on the problem getting worse. The real story was just beginning. On January 12th, gold vaulted to a record above $4,600 per ounce. The catalyst was an escalation in the confrontation between President Trump and Federal Reserve Chair Jerome Powell. Reports indicated that federal prosecutors had opened a criminal investigation into Powell related to his June testimony before the Senate Banking Committee. Powell accused the Trump administration of pressuring the central bank to align with its policy preferences. The Trump administration denied the characterization, but the market interpreted the conflict as a threat to Fed independence. When investors lose confidence in central bank independence, they buy gold. When they buy gold, they often buy silver. The correlation between the two metals tightened as uncertainty deepened. Gold surged more than 64% in 20. Silver logged its strongest year on record, with a 146.8% gain. The last time precious metals performed this well, the Hunt brothers were cornering the silver market, and inflation was destroying the dollar. Geopolitical tensions provided additional fuel.
Protests in Iran raised the risk of wider conflict. The Trump administration removed Venezuelan President Nicolas Maduro, creating uncertainty about oil supplies. Tensions between the United States and China over trade, technology in Taiwan showed no signs of easing. In this environment, the $74.6 billion Fed injection looks less like routine liquidity management and more like emergency intervention. The question is, intervention against what? The signal is undeniable. Follow the money. On Halloween 2025, one or more banks received $51 billion in emergency cash from the New York Fed. This was the first major repo operation after years of virtually no activity. Then came December's record injection. Between Halloween and New Year's Eve, the Fed injected over $125 billion into the banking system through emergency facilities. The identities of the recipient banks remain classified under Federal Reserve disclosure rules. We won't know who needed that money until 2027 or later, but we can make educated guesses based on the collateral. $43.1 billion of the December 31st injection was backed by mortgage-backed security. These are the instruments that banks hold on their balance sheets, often at valuations that don't reflect current market pricing. When a bank needs emergency cash and pledges MBS as collateral, it suggests the bank either can't sell those securities in the open market or doesn't want to realize losses by doing so. The CME announced margin tightening on gold and silver the same week, citing volatility in precious metals markets. If banks were short precious metals and facing margin calls, they would need cash immediately. The Fed's standing repo facility provides exactly that kind of emergency liquidity. Here's what they're not telling you. The December 12th policy change removed the aggregate limit on standing overnight repo operations. Previously, there was a cap on how much the banking industry could borrow through this facility. That cap no longer exists. The Fed has given itself unlimited capacity to provide emergency funding. You don't remove caps unless you expect to need the capacity. The New York Fed's Reserve Management Purchase Statement indicates the elevated pace of Treasury bill purchases should continue for a few months, because non-reserve liabilities tend to jump around April. That's tax season. The Fed is pre-positioning liquidity for the next stress point. Meanwhile, the U.S. Bureau of Industry and Security is scheduled to conduct a review in January and February to determine if silver poses a threat to national security. The United States added silver to its nationally designated list of critical minerals in November, citing its use in electrical circuits, batteries, solar cells, and medical instruments. When a government classifies a commodity as critical to national security while simultaneously providing record emergency funding to banks, the implication is clear.
something in the financial system is exposed to that commodity. The next move would prove decisive. Where does this lead? The Federal Reserve just executed the largest emergency lending operation in years. China has locked down 60 to 70% of global silver export capacity. Physical silver is trading at historic premiums over paper prices. Gold has hit all-time highs, and we're supposed to believe this is all routine. The pattern suggests a system under stress. Emergency facilities being used at record levels, margin requirements spiking, physical metal being hoarded, while paper contracts settle in cash. Central banks buying gold at the fastest pace since the Bretton Woods era. Smart money is positioning accordingly. Chinese companies are offering to buy physical silver at $8 to $10 above market prices. Indian buyers are paying similar premium. The physical market is speaking clearly. Real metal is worth more than paper promises. The Fed's liquidity injection bought time, but it didn't solve the underlying problem. The global silver market is in its 5th consecutive year of deficit. China controls the refining infrastructure. Industrial demand keeps growing. Supply can't keep pace. At some point, the paper price and the physical price must reconcile. Either paper prices rise to meet physical reality, or the paper market loses credibility entirely. We're watching that reconciliation happen in real time. The question isn't whether this story continues, the question is how it ends. What happens when the next stress point arrives, and the Fed has already removed the caps on emergency lending? What happens when April tax season creates another liquidity crunch? What happens if China tightens export restrictions further, or halts them entirely? The data is clear. The $74.6 billion injection wasn't routine. The silver market isn't functioning normally. The premium between East and West isn't close. And the classified identities of the banks that needed emergency funding suggest someone doesn't want us to know who's exposed. This story isn't over. The Fed has signaled it expects more stress ahead by removing lending limits and pre-positioning liquidity. China has signaled it values strategic control over silver more than export revenue. The market has signaled that physical metal is worth more than paper contracts. The math doesn't lie. When demand exceeds supply for 5 consecutive years, and the world's largest exporter restricts the flow, prices don't stabilize. They break upward. When banks need emergency funding the day before a major supply disruption takes effect, that's not coincidence. That's positioning. Watch the repo data, watch the COMEX delivery reports, watch the Shanghai premium. These are the signals that matter. Not the press releases, not the official explanations. The data, $74.6 billion. On the last day of $85 silver on the first trading days of 12% premiums between Shanghai and New York. These numbers tell a story that official channels aren't telling. The vault is draining. The banks needed emergency cash. And the price of silver is telling you exactly what that means. The weight of these events sits with anyone paying attention. The next chapter writes itself based on the same forces already in motion. More deficits, more delivery failures, more emergency injection until something breaks, or the price reflects reality. We're watching the early stages of that process. The question is whether you're positioned for what comes next.